Hi, welcome to Chapter 3. I'm going to spend a brief amount of time with you here today, sort of setting up a frame for your Chapter 3 so that you can build an understanding of where we're headed here. In Chapter 1 and 2, you're definitely introduced to a whole lot of new terminology and new ideas as we're learning about accounting and financial reporting in the governmental areas. Chapter 2, you get to take a really good look at that CAFR and what the components of it are. And at this point, you're probably already busy working on your CAFR project there for the city of Aurora, starting to really look at a real CAFR, which will be really exciting project for you. In Chapter 3, we're going to be talking about modified accrual accounting and the role of fund balances and the budgetary authority. These are three really independent yet related topics for you to sort of develop. And then they're going to be used in later chapters as we move through each of the funds and learn the accounting for them. So what I'm going to do is I'm going to move into a couple of these slides here that just sort of identify, hey, what are some of the accounts that we're going to be using? They call them activity accounts. Revenues is one, if you see here on the slide, that you're used to seeing. All the inflows, taxes, charges for services, and amounts provided by other entities, state or federal. Revenues is a term that we're used to seeing in accounting. So now I just need you to start thinking of it in the context of governmental accounting. Another thing that's going to be new to you that you're going to see here is this other financing sources. So in addition to revenues, we're also going to be receiving transfers in from other funds, and then also long-term borrowing. Those resources that we obtain from a long-term borrowing, we call other financing sources. So recall what we're focusing on here is from a governmental entity under modified accrual accounting. Hey, what are the sources of funds that we have available to us this accounting period? And here are the two main sources, other financing sources, and then of course primary there is the revenues. Then the other thing we look at is, hey, what are we going to use the funds that we have available in governmental accounting for? And so they're really going to be, again, pretty much two different areas. The first of which is expenditures. And this is the money that we spend when a liability is incurred that's going to be settled within the current financial resources of the fund this accounting period. Then we want to go ahead and call it an expenditure. We're going to use them for typical things like salaries. We could be buying land, building, equipment, payment of interest, debt. So expenditures could be on many different things. The key here is we're recording the expenditure this period representing the use of a current financial resource of the fund. Okay. Then we have transfers out of the fund, and we're going to call those other financing uses. Now this is going to be a new term for you. If you recall in the previous slide, we had other financing sources. That was when money was being transferred into the fund. If money is being transferred out of the fund, we're going to be calling it other financing uses. Now for many of these terms that you're learning, other financing sources, other financing uses, the use of the word expenditure, and even revenues, conceptually you can get your hands around the ideas, but they're going to become a whole lot more clear when we get to the journal entries, which are coming soon in Chapter 4. So when we're looking at inflows and outflows, we're going to see there are revenues and our expenditures. Of course, revenues are going to be inflows, and we're going to classify those by source. So where's the money coming from? Taxes, license, permits, are we charging for a service? And then it can be further subdivided there by, hey, what is the type of tax, etc. And we can get into some pretty good details on types of revenues depending on the governmental entity that we're looking at. Expenditures and then encumbrances, which I have not yet gotten to talk to you about, but that's coming up here. They're going to be classified by, they could be what is their function, what program are they related to, department, activity, character, object. So as we look at these governmental entities, we know that we're going to be sorting into two buckets, revenues, expenses, or I'm sorry, expenditures. Here I go. But beyond that, we're going to be sorting further by, how do they fit with the organizational structure so we can sort of understand them and link them. And on the next slide here, you can review this. These are the further character groupings that we could see happening. I'm going to move forward to the next slide here, which introduces us to the concept of budgetary accounting. Now, we've learned about budgeting in accounting classes surely before and probably seen budgeting in place. But here we're talking about budgetary accounting. And this is where the Gatsby requires governments to actually present a comparison of budgeted and actual results for the general funds, and then to clarify, and special revenue funds that have legally adopted budgets. So that's the key. If there is a legally adopted budget, then you're going to need to do the budgetary comparison schedule. So the Gatsby is mandating this for those funds with the legally adopted budgets. Now, Gatsby standards guide the format of this, but they don't prescribe it. And this is sometimes, ironically, a very specific question that the CPA exam likes to ask. So focusing in on, hey, the Gatsby does not actually prescribe the format. They just guide it and they require it if there's a legally adopted budget present. So we'll get into the whole recording of the budget, what that entries look like, etc. But what do governmental entities do with these budgets? Well, first of all, let's just be clear that it's really important that if we have a legally adopted budget, we don't want to go over it. We want to hit the budget. We want to be fiscally responsible with it. So we are going to use the budget in the accounting world and pay a lot of attention to it to make sure we don't go over it. So we're not going to necessarily put the budgetary accounts in the general purpose financial statements. We are perhaps going to include them in our accounting system during the period, just to assure we're complying with it, just to make sure we're not going over it. Now on this next slide, we get to see our first look at an entry where we would be recording the budget. And if you've done a good job of learning your debits and credits, and you know where normal accounts go, and you look at this budgetary entry, what you see here is that we have estimated revenues and estimated other financing sources being debited. Now, revenues are typically an account that we would see on the credit side. Now, the budgetary entries are going to go into the accounts opposite. And there's a reason for that. The real reason is we want to be able to see where we're at. So by putting the estimated revenues in as a debit, as the live revenues come in on the credit side, I'm constantly able to see exactly where I stand. The same thing for the estimated or budgeted revenues, which we call appropriations. You see them here on the slide at 11,700,000. Those would normally be, the live accounts would be on the debit side. Here we are crediting them. And again, as the live expenditures happen, they'll debit them. And then we'll be able to see exactly where we stand in relation to the total appropriation. Part of the budget can also include the estimated other financing sources and the estimated other financing uses. And then the budgetary fund balance in this entry is the difference between what I'm thinking my revenues and sources look like in relation to my appropriations or budgeted expenditures and uses. So it could be a credit or it could be a debit depending on how my budget's falling out. But I do like to think of that number as a number that is plugged. That's what makes that journal entry work. That's where I think I'm going to land. Now on this slide, I kind of define the accounts. So what's an estimated revenue? What's an appropriation? What's an estimated financing source or use? Of course, estimated revenues very clearly are, the revenues that we expect to raise during the budget period. Appropriation, that's a new term. When it's enacted into law is the legal authorization for the government to incur liabilities, to spend the money for whatever purpose that appropriation is stated for. So appropriations are our legal authority to incur expenditures for those items. And then we'd have other financing sources and uses here as well. Another new term that you're going to see in Chapter 3 is encumbrances. And encumbrances are a new term that are used in budgetary accounting. And we're going to use these whenever we've made a big commitment of money. And to me, I like to think of it as I just want to make sure everybody knows that I've made a big commitment of money against an appropriation item. And this allows me to sort of get it into the books. It's not an actual liability yet. It's more of a placeholder. So like a purchase order, a contract is issued. So then what I would do is I would record an encumbrance. And as we note here, it says it's not a liability since the goods or services haven't actually been ordered or received, but I have made a commitment. I'm moving towards it. I really want to let everybody know that amount of that appropriation has actually been marked for something. We're going to be actually using budgetary accounts, and we're going to record them in the books. And so the two new accounts that we're going to be using are actually an account called encumbrances and then a budgetary fund balance reserved for encumbrances. Those are the two new ones that we're going to see. And the next entry on this page, you might want to spend some time studying this one. We actually look at the encumbrances and how they're recorded. So in this example, I place an order for $150,000, which consists of 3 minibuses costing $50,000 each. So I've placed the order. So what I'm going to do is I'm going to debit the encumbrance account, and I'm going to credit budgetary fund balance reserved for encumbrance, and that will go into my books and sort of hold that money on those items. And then as the buses arrive, and here it says, assume 2 of the buses arrive, but with freight, they end up costing $102,000 instead of $100,000. The very first thing I'm going to do is I'm going to reverse out that encumbrance because all that encumbrance was doing was, was a placeholder. So you see, I'm going to just actually flip that first entry for the exact amount I recorded it at. I had recorded the buses at $50,000 each. This is for 2 buses. So 2 buses at $100,000. I'm going to now debit that budgetary fund balance reserved for encumbrances. And I'm going to credit that encumbrance account, and that will zero that amount out, leaving $50,000 in each of those waiting for that 3rd bus to arrive. And then my second entry is when I'm going to record the live expenditure, and then I'm going to credit whoever I'm paying for these, and here we're going to use accounts payable. And one of the key things I want you to see here is we establish the encumbrance, and then we reverse the encumbrance when the goods arrive, and we want to reverse it at exactly what we recorded it at. I didn't reverse it at 102. I reversed it at 100 because that was what I recorded it at. This next slide gives you just an example of the expenditure cycle, how the City Council approves the budget, and then the departments use that money, purchase orders, they use the encumbrances to stay on target, and then as goods and services are received, those encumbrances are reversed, and then live expenditures are recorded. Another thing that you're going to be looking at in Chapter 3 is the revenue recognition, a concept that you're familiar with in general terms, but now we need to think about governmental revenues, okay? So we have some non-exchange transactions that gives the government a right to receive resources without directly giving equal value. So we're used to a sale where a revenue is earned and something is exchanged, but some of the revenues in governmental are actually going to be non-exchange transactions related to tax revenues and intergovernmental grants. So before the government can actually recognize these revenues, They have to meet eligibility requirements, so we'll be paying close attention to that as we look at these. Here are some of the categories on this next slide that we'll be using. Imposed non-exchange revenues. These are imposed. You're going to pay these. Property taxes, special assessments, fines, forfeits. These are paid in, they're imposed on the taxpayers. Then we have derived, and derived tax revenues are derived as a result of some transaction, some underlying transaction causes them, like sales tax, income tax, motor fuel taxes. If you don't buy anything, you don't have to pay sales taxes. If you don't have any income, you won't be paying income taxes. So that's not the goal here though, right? And then we have some government mandated transactions where the federal government requires lower level expenditures to be incurred, or some voluntary non-exchange transactions that may involve grants or donations that we're going to see here. And then in these next couple slides, as you look through these, you can see that these imposed non-exchange revenues derived and each of the categories are explained in a little more detail. So here you'll see we're going to record the receivable and the allowance for any uncollectible when you have an enforceable claim on the taxes. So at the point on this one, we're talking about property taxes. At the point that the property tax levy has occurred, it's good to go. So I can go ahead and record the taxes receivable. I can establish the revenue, and they'll even give you a percentage of uncollectible taxes that possibly will not get recorded. Now this will be unique to you because we won't have an allowance for doubtful account here. We just won't record the full revenue amount. We'll actually set up an estimated uncollectible taxes account, and we're not going to actually put that amount into revenues. A little different treatment there. And then we'll learn a little more about the accounting for this in Chapter 4, but there's also some of the revenues are going to actually be deferred if I haven't actually received them during the period. This is a modified accrual concept. So we will be seeing us actually debiting the revenues control account and crediting a deferred property taxes account that we'll be learning more about in the next chapter. Again, derived taxes are assessed on some sort of transaction conducted by businesses or citizens. We see on this one an example of that, where the cash is received and then you would record the revenue at that point. You could also be recording a receivable if it's expected to be received. If we're aware of it, then we can set up a receivable and record the revenue. The next slide introduces you to government mandated transactions. These are commonly grants from higher levels of government like the federal government, but it could also be a state government, and they're supporting a program that they're mandating on you. Since this program is required, the lower level government has no choice but to accept it and implement it. And unfortunately, sometimes the money they give isn't actually enough to run the whole program, but it's important that we follow these mandates. And then we have some voluntary non-exchange transactions. These are donations and grants to support specific initiatives or programs. Since it's not required, the receiving government would voluntarily agree to accept that grant or donation. And since it's tied to a specific program, they're going to be using it on that specific program. So it's important that they agree before they accept it. They're going to have to use it that way. And then we sort of see some slides here where it talks about the revenue recognition criteria under modified accrual and when will it be okay to record the receivable and the revenue. So when we're talking about voluntary non-exchange revenues, it's going to be when all the eligibility requirements have been met. And interesting, these government mandated ones are often reimbursement grants. And what that means is that once you've spent the money, once you can show you have expenditures related to this specific mandate they've imposed on you, then you can submit the expenditures and receive reimbursement. So like here we see in the first journal entry, we have an expenditure and then, accounts payable or cash. So we've spent the money. And then the second one, we get to say, okay, now we have a due from this grantor and we can take credit for the revenue. So we wouldn't be recording a reimbursement grant receivable or revenue until after we've met that eligibility criteria of spending that money. Moving to the next one. These would be our government mandated and voluntary non-exchange ones. Sometimes we're going to receive money in advance on these. So we're going to actually not want to record that revenue until we have expenditures. If there's going to be some sort of a disconnect between timing, then we would see a journal entry here like this first one where we see the cash has been received, and then we're going to put it in a deferred revenue account. And then as we spend it in number 2 here, expenditures, control, and accounts payable or cash, then we could take it out of the deferred revenue and then call it like a grant revenue and actually record the revenue. As the budgets are legally enacted, sometimes they're going to come back with budget revisions throughout the year. It could be due to changes in revenue projections or operating conditions. Something changes. They usually are enacted by the appropriate legislative body, and then you would want to record that in your books. It'd be just a modification to that original journal entry, and we'll be seeing more of these budget revision entries as you work through your homework and you work through the book. They kind of give some great examples of these. If you have a legally enacted budget, you're going to be preparing that budgetary comparison schedule. So we're going to have both the original and the final adjusted budget shown on it. And then, of course, the actual, because we're actually comparing those two. There is probably going to be a variance column on there, but that's actually not required. So for me, a budgetary comparison schedule would have the original, the final budgets, and then the actual. And I would certainly like to see a difference, although not required. The actual column that you're going to be recording those under should be under the same basis that the budget was prepared under. And this may be different than a GAAP basis. If it is different than GAAP basis, then we'll have another schedule that reconciles those figures. In the fund financial statements, we're going to find something called a fund balance. And each of these funds, which you've been learning about in chapters 1 and 2, have their own individual fund balance. And we're going to show the balance of these only in the statements for the governmental fund types. So it's not going to affect our proprietary or fiduciary funds. And it's not going to affect the net position that's shown on the government-wide. But under the fund balance financial statements, we do have some unique reporting things that are going on here. We actually report that fund balance into 5 different categories as listed here. We have non-spendable, restricted, committed, assigned, and unassigned. So they want you to look at what's in that fund balance and say, what's the nature of the amount in that fund balance? And let's take a quick look at what those categories break down to. The first and easiest one to break down is to say, hey, what of those are non-spendable? And what they mean by non-spendable is, hey, is it an inventory? Is it a prepaid item? So is that fund balance amount attributed to something that we can't actually spend? Or the principal of a permanent fund, which is actually could be, cash based, but you can't spend it. So that's the first thing. So what's spendable versus non-spendable? And then once you know your spendable resources, then you're going to look at them and say, okay, of the amounts that we have sitting in the fund balance that are spendable, what kind of constraints exist on these? And then just to give you some examples here, so restricted, when we say restricted, I want you to think of something externally imposed on the entity. So we could place restrictions on ourselves. We could use the word restricted. But really restricted means constraints placed that are external, imposed by law. So where they're saying this money is only available to be used for very specific things that were externally imposed on the governmental entity. As opposed to committed funds, these would be constraints, and notice they're careful not to use the word restricted here. They're saying constraints that are placed on the funds that limit what we can use them for. And this could be within the government, the governmental body. It could be your board that decided this and said, hey, these funds are committed to be used for this. This is different than a restriction, although these are still funds constrained to a specific item. And then below that we have assigned funds. So we see it's sort of lessening here, where we sort of see the government has expressed intent to use these. So this would be, funds that we're thinking, where we've expressed the intent to go in this direction. So even a little bit lesser restricted here, because we could change our mind. And then you have your unassigned funds. And this is everything else, the residual classification in the general fund, everything that isn't restricted or assigned or committed would end up in the unassigned amount. Okay, so those are the big pieces that are happening in Chapter 3. I hope this kind of gives you a brief snapshot as you go to review the chapter. The question that I would like to hear from you when you go to collaborate and discuss it is, can you please talk to me a little about the categories of the funds, the 5 different categories for the fund balances, non-spendable, restricted, committed, assigned, and unassigned? Would you please comment on those in your own words, like your understanding of the differences between them? I'll be looking forward to reading those comments on the discussion board. And I'm really looking forward to talking to you about Chapter 4, which is coming up next, because we finally get into some real journal entries. Thank you.